Let me ask you something. Do you remember 2008? Not just the headlines, not just the news anchors in suits trying to explain what a mortgage-backed security was while the whole country watched their savings evaporate. I mean, do you remember what it actually felt like? Families packing up their homes, neighborhoods going quiet, people who did everything right, worked hard, paid their bills, played by the rules, suddenly finding out that the rules had been changed on them without their knowledge, and nobody at the top was going to be held accountable for it. That was 2008. And the reason I need you to understand that feeling right now, the reason this video exists, is because the warning signs that preceded that collapse, they are flashing again, and if anything, they are flashing louder. I know that's not easy to hear, and I know a lot of you watching this right now are already exhausted. You've been watching home prices climb to levels that feel completely disconnected from reality. You've been told to just save more or stop buying avocado toast, as if a $10 breakfast is the reason you can't afford a $400,000 starter home. You've watched investors and landlords scoop up property after property while you've been pushed further and further to the sidelines of the American dream. And now, right now, the data is starting to show that those same landlords who helped price you out are quietly starting to buckle. The debt is catching up, the math is not working, and the warning that housing experts are now sounding is one that every single American, renter, homeowner, or hopeful first-time buyer needs to hear before it's too late. So if you've ever felt like the housing market was rigged against you, if you've ever wondered how this all ends, and if you want to understand what is actually happening beneath the surface of the U.S. real estate market right now, stay locked in, because you are not going to be ready for what I'm about to walk you through. This is Housing Just flashed a 2008 level warning. Landlords are in trouble. Let's get into it. Before we go any further, if this kind of content helps you make sense of what's happening in the economy and the housing market, do me a favor and hit that like button right now. It takes 2 seconds, and it genuinely helps this channel reach more people who need to hear this information. You being here matters, and that one click tells the algorithm to keep putting this in front of people who need it most. The gap that should terrify you. Let's start with a number. Actually, let's start with 2 numbers, because the distance between these 2 numbers is where the entire crisis lives. The median home price in the United States as of mid-2025 sits at approximately $410,800. That is the price of a median home in this country, not a luxury home, not a beachfront property, a median home, the middle of the market. Now here's the second number. The median household income in the United States is approximately $83,730 per year. At first glance, maybe that doesn't hit you the way it should, so let me give you the number that puts it all in perspective. To comfortably afford a median-priced home in America, using the traditional standard that housing costs shouldn't exceed 28% of your gross income, a household would need to be earning approximately $118,530 per year. That means the median American household is earning roughly $35,000 less per year than what's needed to afford the median home. Think about that. The average family in this country is not even in the ballpark. They are not close. The gap between what homes cost and what people actually earn has grown so wide that it has essentially priced an enormous portion of the American population out of homeownership entirely. And here's what makes this even more alarming. This isn't a new problem that snuck up on us. This gap has been building for years. It was accelerated by pandemic-era buying frenzies, by historically low interest rates that drove prices through the roof, and by a wave of investor purchases that absorbed inventory that should have gone to first-time buyers and working families. The average American didn't create this problem. They were caught in it. If you're one of the millions of people sitting at home right now wondering why you're still renting, why you can't seem to get ahead no matter how hard you work, I want you to know that this is not a personal failure. The system created a structural imbalance that made this incredibly difficult for ordinary people. And what's happening now is that the people who benefited most from that imbalance are starting to face consequences that the data is making impossible to hide. Drop a comment below and tell me, are you currently renting, a homeowner, or still trying to break into the market? I want to know where you're standing right now, because this conversation affects everyone differently and your perspective genuinely matters. The 2008 alarm is ringing, and this time, landlords are holding the bag. Now let's talk about why housing analysts are drawing direct comparisons to 2008, because it is not simply a matter of prices being high. High prices alone do not cause a collapse. What causes a collapse is leverage, borrowed money that stops performing the way it was supposed to when the math was written on paper. In 2008, the leverage was concentrated in the hands of individual home buyers who were given mortgages they had no realistic ability to repay. Stated income loans, no-doc loans, adjustable rate mortgages with teaser rates that were always going to reset into payments nobody could afford. The entire machine was built on the assumption that home prices would always go up, and the moment that assumption cracked, the whole structure came down. What we are seeing now is a different version of the same fundamental mistake, but this time, the leverage is concentrated in the hands of landlords and real estate investors, specifically those who used a financial product called a DSCR loan to build their rental portfolios. DSCR stands for Debt Service Coverage Ratio. These loans became enormously popular over the last several years because they allowed investors to qualify for real estate financing based not on their personal income, but on the projected rental income of the property itself. In theory, if the rent covers the mortgage payment, you qualify, even if you have 5 other properties, even if your personal income wouldn't otherwise support the loan. On paper, this sounds logical. In practice, it created the conditions for a feeding frenzy. Investors used DSCR loans to rapidly accumulate rental properties at scale. They didn't need to verify traditional income. They didn't need to jump through the same hoops as a first-time buyer trying to purchase a single home to live in. And as long as rental prices kept rising and interest rates stayed manageable, the math worked. But here's where the alarm gets loud. Serious delinquencies on DSCR loans, loans where the borrower is significantly behind on payments, have nearly quadrupled in just 3 years. Not increased, not ticked upward, nearly quadrupled. That is not a gradual drift in the data. That is a signal that something has gone structurally wrong. And now let's look at what's happening in the multifamily space, because this is where the numbers become almost impossible to ignore. Multifamily loan delinquencies, loans on apartment buildings and larger rental properties, hit 1.37% as of Q3 2025. That is the highest level recorded since the post-2008 recovery era. But the raw percentage doesn't fully capture the scale. The total dollar balance of delinquent multifamily loans has jumped from $2.4 billion to $8.9 billion in just 24 months. Read that again. From $2.4 billion to $8.9 billion in 2 years. That is nearly a $6.5 billion increase in delinquent debt in the multifamily sector alone. And multifamily loss rates, money that lenders are actually losing when these loans go bad, rose from near zero to $911 million in a single quarter by Q3 2025. These are not subtle numbers. These are not minor fluctuations. This is a system under serious stress, and the stress is accelerating. And if you're thinking, okay, but how does this affect me if I'm not a landlord? Make sure you subscribe to this channel right now, because what happens to landlords does not stay with landlords. It ripples directly into your rent, your home's value, your neighborhood, and your financial future. Hit that subscribe button and stay informed. This story is far from over. The expert warnings you need to take seriously. Now, I want to be clear about something. I am not here to tell you that a crash is guaranteed. Nobody has a crystal ball. But when serious, credentialed voices in the housing and financial space start using language that would have seemed extreme just a few years ago, that is something you cannot afford to dismiss. Housing analyst Melody Wright has been one of the most vocal and frankly most specific voices sounding the alarm on what she sees coming. Her analysis points to a potential home price correction of nearly 50% or more in certain markets before the ratio of home prices to median incomes returns to any kind of historical normalcy. 50%. Let's put that into real-world terms. A home currently valued at $410,000 would need to fall to approximately $205,000 for that correction to play out fully. For a homeowner who purchased near the peak, that is the difference between equity and being underwater on their mortgage. For someone who took out a DSCR loan to buy a rental property with projected rents covering the debt service, and those rents are now softening while operating costs have exploded, that kind of correction doesn't just hurt, it wipes them out. And Wright's warning goes further than just price correction. She has specifically highlighted the concern that the backstop that existed in 2008, large institutional investors and private equity stepping in to purchase distressed properties at scale and arrest the freefall, may not materialize in the same way this time around. In 2008 and 2009, Blackstone and similar firms spent billions scooping up single-family homes in bulk, stabilizing prices in hard-hit markets faster than the free market alone would have. But we are now in a different environment. Interest rates are higher, capital deployment is more cautious, and the institutional buyers who could theoretically absorb a wave of distressed inventory may not be positioned or willing to step in at the same scale. Which means if the correction comes, it may have further to fall before it finds a bottom. Robert Kiyosaki, author of Rich Dad Poor Dad and one of the most well-known voices in personal finance and real estate investing, has also gone on record warning of what he has called the biggest crash in history, pointing to the convergence of debt, demographic shifts, and over-leveraged real estate as a trifecta of risk that the market has not fully priced in. Now, Kiyosaki has made bold predictions before, and not all of them have landed on the exact timeline he projected. But the pattern of credible voices converging on a similar theme, that the housing market is overextended, that landlord debt is becoming unmanageable, and that a significant correction is more likely now than it has been in over a decade, is something that deserves serious attention. The landlord math that no longer works. Let's take a moment to really understand why landlords specifically are in trouble right now, because this is not simply a story of people who made bad bets and deserve what they get. The dynamics that are squeezing landlords have been building over years, and understanding them helps explain what the broader consequences are likely to be. When a landlord purchases a property using a DSCR loan, the fundamental assumption is that rental income will reliably cover the mortgage payment plus operating costs, with enough left over to justify the investment. That math was workable in an environment of rising rents and relatively stable operating costs, but the environment has changed, sharply. Property taxes have risen significantly in many markets, particularly in areas where home values surged during the pandemic. When the assessed value of your rental property goes up, your tax bill follows. That's an operating cost landlords cannot negotiate away. Insurance costs have absolutely exploded in many parts of the country, particularly in states like Florida, Texas, and California that have seen increasing frequency of weather-related losses. Landlords in some markets are seeing insurance premiums double or triple in just a few years. Some are struggling to find coverage at all. An asset that cannot be insured is an asset that cannot be financed. Maintenance and repair costs have tracked inflation and in many cases exceeded it, as material and labor costs remain elevated. A roof replacement, an HVAC system failure, a plumbing issue, these are not optional expenses. They come due regardless of what the rental market is doing. And here is the crucial part. All of these rising costs are colliding with a rental market that has, in many areas, softened. The era of 20%, 30%, 40% rent increases that landlords enjoyed during the pandemic years is over in many markets. New multifamily supply has come online in cities that saw massive construction booms. Renters who were pushed to their absolute limits on affordability have begun to double up, move to lower-cost markets, or otherwise resist further rent increases. So what you have is a cost structure that keeps rising, pressing against a revenue ceiling that's no longer moving in the same direction. That is a cash flow squeeze. And for landlords who are already carrying high-interest debt from recent acquisitions, many made with DSCR loans at rates that seemed acceptable when the projections were rosier, the margin for error has essentially disappeared. This is how you get delinquencies that nearly quadruple in 3 years. This is how you get $8.9 billion in delinquent multifamily debt. This is how warning signs that look like data points on a spreadsheet translate into real-world instability that affects every single person who rents a home, owns a home, or is trying to buy one. I want to ask you something. Comment below what you think about landlords who use these DSCR loans to buy up multiple properties while first-time buyers were getting priced out. Do you think they should be bailed out if this goes sideways, or should the market correct itself? Be honest. I genuinely want to know where you stand on this. What happens to renters when landlords fail? This is the part of the story that I think gets lost in the financial data, and it's the part that matters most for the majority of people watching this video. When a landlord goes delinquent on a DSCR loan, when the bank eventually forecloses on a rental property, what happens to the people living in it? In some cases, the property gets sold at auction to another investor or an owner-occupant. In some cases, it gets absorbed into bank-owned inventory. In some cases, renters receive notices that their lease will not be renewed or that they need to vacate. In every case, there is disruption, there is uncertainty. There is the very real possibility that families who have been paying their rent faithfully, who have done nothing wrong, find themselves scrambling to find new housing in a market that is still incredibly difficult. And here is the painful irony of this whole situation. The very renters who were priced out of homeownership by the investor-landlord buying frenzy of the last several years, the people who were told to just keep renting because they couldn't compete with cash-heavy institutional buyers, are now the most vulnerable to the fallout if those same investors cannot service their debt. They didn't cause the problem. They were a product of the problem. And they may end up bearing a disproportionate share of the consequences. I think about the families out there right now who are paying rent every single month, sometimes stretching budgets to the absolute limit, dealing with the stress of not knowing if their landlord is one bad quarter away from foreclosure. That kind of financial uncertainty takes a real toll on people, on marriages, on mental health, on kids who deserve stability. And it is not something that gets talked about enough in these conversations about what the market is doing. If you're in that situation right now, if you're renting and you're worried, I want you to know that you are not alone, and staying informed is the most powerful thing you can do to protect yourself and your family. The 53% signal, what Zillow's data is telling us. One of the most striking data points that has emerged in recent months comes directly from Zillow. According to their analysis, 53% of U.S. homes lost value over the past year, the highest share of homes experiencing price declines since 2012. Think about what that means. More than half of homes across the country are worth less than they were a year ago. That is not a regional story. That is a national trend. Now, some of these declines are modest, fractional percentage points in markets that simply cooled from overheated levels, but the breadth of the trend is significant. When price declines are this widespread, it signals that the broader market has shifted from appreciation to correction, and corrections have a way of feeding on themselves. Sellers who would have listed at higher prices hold back. Buyers who see prices declining wait to see if they fall further. Inventory builds, demand softens, and the downward pressure deepens. For landlords carrying debt against properties that are now worth less than they were when the loan was written, this creates an additional layer of danger. Negative equity, being underwater on a property, doesn't just affect your net worth on paper. It affects your ability to refinance. It affects your ability to sell if the cash flow problem becomes unsustainable. It removes the escape valves that leveraged investors depend on when their business model comes under stress. And this is happening while delinquencies are rising, while operating costs are squeezing margins, and while the rental market in many areas is no longer capable of absorbing further increases. The data is not pointing in one alarming direction. It is pointing in multiple alarming directions simultaneously, and they are all converging. Why this matters more than 2008 for ordinary Americans. Here is the argument that housing analysts like Melody Wright are making, and it is one that deserves serious weight. In 2008, the crisis was primarily a homeowner crisis. The people who lost the most were individual families who had purchased homes with loans they couldn't sustain. The mechanism of collapse was the residential mortgage market. What we may be looking at now is a crisis that hits at a different layer of the housing stack, the investment layer, but whose consequences cascade down into the rental market, the residential sales market, and ultimately the broader economy in ways that could be harder to contain. When homeowners defaulted in 2008, they lost their homes. When landlords default at scale, renters lose their stability, housing supply is disrupted, local governments lose tax revenue, and the banks holding the debt face the same liquidity pressures that froze credit markets 15 years ago. And the backstop, the cavalry that rode in last time, may not be coming. Melody Wright's specific warning is that the institutional investor community, which played a crucial stabilizing role in 2008 by absorbing distressed inventory, is not positioned to do that again at the same scale in the current rate environment. The cost of capital is too high, the risk calculus has changed, and without that backstop, A wave of distressed property hitting the market at once could push prices down further and faster than most people's models currently account for. This is the moment, if you haven't already, to hit that like button and share this video with someone you know who needs to understand what is happening in the housing market. This information needs to spread beyond financial media echo chambers and reach the people it actually affects most. Hit like right now, and let's keep going. What you should actually be doing with this information. I want to be responsible here because the goal of this channel is never to cause panic. Panic is not a financial strategy, but informed vigilance absolutely is. If you are a renter, the most important thing you can do right now is understand the financial health of your landlord's property, to whatever extent that information is available to you. Know your rights in your state regarding foreclosure and tenant protections. Build your emergency savings aggressively. Avoid signing long-term leases in properties that show signs of deferred maintenance or management instability. Stay liquid. If you are a homeowner, the key metric to watch is your loan-to-value ratio, the relationship between what you owe and what your home is worth. Broad price declines in your market are worth monitoring closely. If you are sitting on significant equity, protect it. Avoid cash-out refinancing to fund consumption spending in an uncertain environment. Your equity is one of the most important financial buffers you have. If you are a prospective buyer who has been waiting for prices to come down, the data is beginning to suggest that patience may be rewarded in certain markets. But do not interpret a correction as an invitation to rush in. Falling markets can fall further than initial estimates suggest, and buying into a declining market without a long-term plan and solid financial footing is its own form of risk. Be deliberate, be patient, be informed. And if you are an investor or landlord watching this and recognizing some of your own situation in the dynamics I've described, now is the time for absolute financial honesty about your portfolio. Are your properties cash flowing? Can they sustain further rate increases or insurance cost escalations? Are you holding debt that relies on rent levels that are no longer achievable in your market? These are not comfortable questions, but they are the right ones. The bigger picture, a system that needs to reckon with itself. I want to close by stepping back and saying something that I think needs to be said plainly. The housing affordability crisis in America was not an accident. It was the predictable result of policy choices, financial products, and investment behaviors that prioritized short-term returns over long-term stability for ordinary Americans. The DSCR loan explosion that allowed investors to hoover up properties that working families needed. The zoning restrictions that strangled new supply. The monetary policy that sent interest rates to near zero for over a decade, flooding the real estate market with speculative capital. The corporate landlords who turned single-family homes into financial instruments. All of it contributed to a situation where the median American family cannot afford the median American home, and where the people who most profited from that situation are now showing the first real signs of structural distress. What happens next will depend enormously on how quickly the financial system responds to the stress signals, how policymakers decide to react if the distress accelerates, and whether the backstops that existed in 2008 will materialize again, or whether this correction finds its own bottom on its own timeline. What is not in doubt is that the warning signs are real, the data is clear, and the stakes for every single American, not just investors, not just banks, not just people who pay attention to financial media, are genuinely high. I want to hear from you one final time. Comment below. Do you think we're heading for a housing crash worse than 2008? Or do you think the market finds a soft landing? No wrong answers. I want to know what you actually think, based on what you're seeing in your own community and your own financial life. The housing market has flashed this warning before. In 2008, most people didn't see it coming until it was already on top of them. The difference this time is that the data is visible, the experts are speaking clearly, and you now have the information you need to make smart, deliberate decisions for yourself and your family, regardless of what the market does next. Stay informed, stay liquid, and stay ahead of this. If this video gave you something to think about, make sure you're subscribed to this channel. We cover the housing market and economy in a way that actually respects your intelligence and your financial situation. And click another video on your screen to keep watching, because the full picture of what's happening in the real estate economy goes even deeper than what we covered today.